first of all, I'm really excited about this talk. Just some background on myself. As I mentioned, I've been in the tech and startup space, mostly as a chief operating officer, but back in 2012, I was a Techstars associate in the New York program. I think it was the second program in New York, and it was very exciting days. So it's exciting. I've been a mentor since, so it's exciting to kind of come back and see the program. And maybe we can start with some background. Can you just give us a little background on yourself? Maybe even just kind of what you did before Techstars and your role here to start?
Yeah, for sure. You forgot to mention how amazing your class was.
Yeah, we had a good class. It was 2012. It was ClassPass, which was probably had the best outcome. And one of my other associates was the founder of Plaid, and Bench was another company that came out of there. So we had a really, really great, meaningful and great class. So yeah, those are exciting times. But yeah, can you give us some of your background? I think it's helpful for people to hear.
Sure. Hey everyone, my name is Christine Hong. I'm the investment manager for the Techstars New York JP Morgan program. I work with the managing director, KJ Singh. And before this, I also worked on the regular New York program. This is my first investor role. And before this, I was a software engineer, product manager, and founder. I worked at companies like Tinder and LinkedIn and Yahoo and really small, like 2-person startups as like founding engineer as well. Happy to talk more about my company, Albi, that I started before this as well. But yeah, basically I met my managing director when I was a founder. So I knew after I wound out that company, I really wanted to be on the other side, helping startup founders every day. And that's how I ended up here.
Yeah, and KJ, who was here earlier but had to jump to a meeting, he's been managing the program for how long?
More than a decade. Yeah. He's the longest running managing director at Techstars, actually.
Yeah, so he's been doing it for quite a while. And just a quick differentiation, the Techstars New York, Techstars powered by JP Morgan, is it 2 different programs, just so everyone can
It's technically 2 different programs. So, I mean, what that generally means is that there's 2 different investment teams on it. So there's slightly different preferences in terms of sectors or what they look for. But you can apply to both. It's great in the sense that like, Techstars is kind of like applying to multiple funds at the same time. So like, I feel like at this stage it's so early and people can be so biased, especially when you're so early in traction. So you get like several different points of view who decide versus just like one.
Great. So this talk, the questions I have set up really follow the Techstars program. And I think that's most of the questions that Dorothy and I get when we work with founders. We're gonna just go step by step so you see what's going on behind the scenes. I think that helps you as founders decide, is this for you, or is an accelerator for you? Is Techstars for you? Should you apply? The answer isn't always yes. So let's start with the selection process. I think that is a big mystery for folks. Like, can you tell us about how many applications do you get and kind of what the process is like from your side as you're looking through those applications and trying to figure out what the next class looks like?
Yeah, for sure. It depends on the program. For example, our space program is pretty niche, so there's going to be less applications. But for our New York programs, we tend to get over 1,000 applications, and we end up selecting 12 companies. It does sound pretty insane, but people reapply all the time. They're considered by multiple programs. So like things will work. Just keep going and like things will work out. Yeah.
And so just from a practical standpoint, you're getting applications just all the time. And are you all screening those applications? How do you go through that process?
Yeah, so they're from all over the world and they're coming in. Well, we have a fall program and a spring program now. So there's a certain like amount of time that you can apply for the fall program. Technically, apps closed a couple weeks ago, but we're taking late applications right now for our fall program. Basically, while I'm running the spring program, I do go through the fall applications, but I tend to like go through them all like the last couple weeks after the weeks after program ends, because I really want to be working on the spring program and like helping our founders succeed instead of going through fall applications, I would say. So a lot of the email outreach will come in between programs. Yeah.
Got it. And a lot of, I've heard other Techstars MDs talk about how to build a relationship with the investment team. Mm-hmm. Is that something you recommend founders do as they're building, as they're applying? Like, what's the best way for them to develop that relationship? And how helpful is it?
Yeah, that's really hard because I think the answers for founders are always like, do everything, like make sure you're building all your relationships with potential customers and like investors and you're also trying to build your business and like a million different things, obviously, ideally, the answer is yes. Like, I would say a lot of people we invest in, I think we're the earliest stage, so this would be less so, but traditional investors, a lot of people they invest in, they've known for a while, they've kind of seen them like come back to them every month or 2 months with an email update on progress, and like you kind of get conviction of the founder because you see how much progress they made in like the past 6 months or something. So it always helps to try to reach out to the Techstars team. We're pretty accessible, I would say. Obviously apply, but there's always people who try to get referrals into us or like cold outreach us, and can't always guarantee a reply, but I mean, this is the name of the game for like anything in life, you know, get your in through the door. Yeah.
Yeah, it's like you have to think there's 1,000 startups applying, let alone the startups that you might know of already and be reaching out to come into the program. There's got to be a way to stand out, or you have to kind of make yourself stand out in some way or build a relationship so you have
life is relationships.
And then talk a little bit about the criteria when you're selecting. It's a huge top of funnel, 1,000 plus. What criteria are you looking to narrow that list down to ultimately? How many do you select in that program?
12.
12. So yeah, let's call it like 1,200 to 12. What's the criteria that you're using?
Yeah. Well, at Techstars, we like to say we look at for 6 things. It's team, market, product, traction, in that order. So like we're so early, like we take companies like almost no traction or very little, but they're usually post-product, I would say. I mean, it would be more useful to be post-product while going through the accelerator, because like you want to get your equities worth, and like we can't help you accelerate your growth if you don't have a product, right? So the companies I talk to, I like want to make sure they have a product at least by the time the program starts, because I want it to be like a mutually happy in terms of investment. And then in terms of team, like we're looking for usually like 2 co-founders, at least one who's technical. Like companies tend to ship faster. We've invested in people who didn't have a technical founder or solo founders. But you know, we generally, there's always exceptions to every rule, but I've usually seen like that formula tends to work better. Like working on a startup is like so hard that it's just so much better with a co-founder. And usually people have like maybe worked together, like ideally, but again, exceptions to every rule. Like company in our last batch met through a YC co-founder match, which is like usually kind of frowned upon, but like they worked out really well. They raised their 3 million seed before end of program even, like got to like 700 AR in like 5 weeks during the program. So pretty impressive. In terms of market, like are you tackling like a market that could potentially be like billions of dollars? So does that mean like, can you potentially make 100 million annual revenue at least? That's pretty well known among investors that they need to be able to make money back from the investment they made from the founders. The reason we still put team before market is because the best teams can pivot and like eventually find a market that's the right fit. So I kind of like look into that, like, do they have the potential to, like, can I guide them to market? That's why I like to talk to companies early before we accept them, because like I might be able to help them along the way, and then like check in again like a month or 2 later and see how much change there's been. And then product obviously, like, is it a good product? And then like I'd say traction last, because like things can really change in like a month even with startups. So I'm looking for companies like basically who can grow really quickly, not like necessarily have a lot, maybe just started like a month ago versus like have a ton of traction now. I've been working on it for like a year, you know.
Got it. And what do you see are some common mistakes when you see people submit their applications?
Just not being succinct. I would say like you do realize like I am going through like more than 1,000 applications. Like I only have so much time to read it. I would say it's similar to a deck. When you send a deck, expect investors to go through it like for like 20 seconds. So like 1 to 2 seconds per slide. It's very like blip, blip, blip. Like what can I get from it? So it's like problem, like understand that 1 line. Solution, like understand that like 1 or 2 lines and being like super clear. Like people will write like huge paragraphs. So we started adding in character limits actually for our applications.
I think that's a good point, because your whole life, your work, or your whole application, and you're working on your startup, it's everything that you're doing. But for the person receiving it, that's 20 seconds of their evaluation time. And so you really kind of have to cut to the chase. So I've seen decks where it's like they want to tell a story where the big conclusion's at the end versus just say the conclusion first.
Say the most important thing first.
And then just like get it out there.
People might not even read the second half of your deck. And we ask for a deck in our application to make it like easy to like fill it out quickly, because like you're usually using a deck for everything. I'm always glancing at traction revenue just in case. But that's like the obvious one. I would say also, I usually almost always check the founder LinkedIns just in case like something seems to stand out in terms of their background or it seems like a strong team. So even if like it's like low traction, I might like reach out to them if the space is interesting, the founders. Like a lot of people aren't great at updating their LinkedIns, which is like fine, but I think you should realize investors are looking at that and like we really care if founders are working full time on something. So like I'll reach out and ask if they are full time. A lot of people don't have the same patience as me. So like they'll be like, oh, they're not even working this full time. Like why should I talk to them? They're not very serious about their business. But like if you are, like please update your LinkedIn.
It's little things like that. That's like how you can market yourself beyond your application.
Yeah, or they have a CTO, but it's not even listed on the app or on LinkedIn, and I like find out later. Yeah.
Now, what about Techstars has a lot of regional programs.
Yep.
One, could you just comment a little bit about it's been kind of Techstars made an announcement that maybe there's some more consolidation going on that front. That as the first piece, and the second question being, what does the region matter? Like, should people in New York only apply for New York, or how does that matter?
So that's a pretty common misconception. Our programs have always taken companies from all over the world. Like only, I would say, a quarter of our companies last program were based in New York. There's some companies that were looking to move to New York after where they were based, but like the other half were planning to stay based outside of New York. The reason we have city programs is because it means like you're trying to like really take advantage of that region. Like a lot of FinTech companies like want to come to New York, or like we'll have a Canada-based company that wants to sell into US healthcare system. They come to New York, and like New York's really strong in that. So I would say like go based on like what you think the region could help you in. If you want to target like New York VCs, target New York. You want to target LA, like target, maybe you're a career economy company, go to LA, but we don't really care where you're based. And that's why we're kind of like fine. We're doing this consolidation now because we really want to consolidate the fundraising resources we give. So we're focused on like the powerhouse regions in US. So that would be SF, LA, New York, Boston and Baltimore now. But you can be based anywhere to do a Techstars program. Just think about which city will help you the most. Yeah.
Got it. So let's move into the program itself.
Yeah.
Just to start, what would you say is the main goal of the program? Because I think people hear the word accelerator and they might think about accelerating their business or securing funding, but how would you encapsulate like kind of what the point of doing Techstars is as a founder?
Yeah, I really hate the word accelerator because it sounds like school, and I think the word is really overused now. Like there's a lot of like equity-free programs or like half-baked, remote, 4 weeks part-time, whatever, and like they call themselves accelerators. So like sometimes like people come to us and be like, I have no interest in Techstars. Like they have like accelerator fatigue, and I have to like really explain like we're not going to give you a bunch of generic workshops and things like that. Like our program is super personalized to give whatever you need to get to next stage of your business. So like none of our workshops, almost all of our workshops are not required. We try to bring in speakers in person so you develop that relationship. Some of the talks are like with like really high level partner VCs. So you kind of like start building that relationship informally before you're pitching them. It's like a classic example what you should be doing, but I get it. It's like you don't have connections. You're busy. So we're like bringing in these really connected people to help you. Our bread and butter is really our mentorship program. And this is like super like interesting for me because it's like weeks 2 and 3, we're assigning you to 30 to 40 mentors back to back based on like what you need the most help in. So I survey all of our companies beforehand, what do they need help in? I see if we need to recruit specific mentors based on it. Like one of our companies last program needed to be connected more home health agencies. There's like 1,000 home health agencies in like United States. There's very few. So I had to like go into our like international Techstars database. We have a whole mentor team to like look for specific mentors to add for the upcoming program. It's not like, we reuse it. Andrew's one of our mentors. That's how I know him. And And then like a lot of it's like really personalized about the weekly one-on-ones, like what do you need help in, like what can we do to get you next stage of growth? The one-on-ones are like, what KPIs should you be focusing on? Sometimes we're kind of like, hey, you're kind of trying to do both enterprise and consumer. You might need to focus on one. And also we have these paid business associates on site, which is like pretty rare. I don't think Andrew explained what he was doing, but basically it's kind of like having a free high-level full-time like employee on your company that like you don't pay for yourself. We're paying for them because we know you have to do a million things, and these folks are like creating sales pipelines for you. You could give them a sales email address to reach out for you, like creating investor pipelines for your outreach, doing financial modeling for you, helping you do product design, basically anything except for coding, because we tried dev associates and like it always ended up like making the architecture break later for companies, so like wasn't a great idea actually. And some of these will even get hired full time as like early startup employees. So that's just kind of examples of like what we're doing. It's really not school because you're building a business.
Yeah, it's like I was an associate, as I mentioned. I was post-business school helping the companies out. I ended up joining one as a chief operating officer afterwards, but it's like resources that are just there and helping that you may not, as an early stage startup founder, want to hire or just need a little bit of. So it's super helpful.
And it's super ad hoc. Like we helped 2 of our companies raise their full pre-seed before programming started, after an offer. And we'll introduce you mentors like after Mentor Madness, like ad hoc based on what you need. Like everything's very like personalized to your time. And also like I would say instead of like demo day is a great graduation capstone ceremony, but we do like a personalized investor week where it's like creating that calendar density you need to fundraise, like back-to-back one-on-one 30-minute meetings in a single week with VCs who already pre-vetted interest in you, a lot of things like that. Yeah.
Got it. And just at a high level, the program itself, like how many weeks is it? And is there a structure to the like phase 1, phase 2, phase 3 type to the program? Yeah,
for sure. So week 1 is kind of like the intro, like that's like the most workshop heavy week, I would say. Just like make sure you're up to stuff on your pitch, financial model, things like that. If you're behind, we're gonna have to work on that with you guys one-on-one. Weeks 2 through our Mentor Madness, as I said, like you're gonna meet a bunch of mentors. It's gonna be like exhausting with meetings, but like normally having these amount of like quality meetings would probably take you more than a year on your own to get. So it's really worth it because these mentors will be your like first introductions to angel checks and like sales partners and things like that. And like it'll make sales and like fundraising much faster. After that, just like really like focusing on your growth and really pushing you one-on-one. Week 6, we'd start kind of like, that's like midway through program, because program is 3 months. Week 6, we really start like making sure your fundraising materials will be up to snuff by the time we get to week 11, which is investor week. So we're just making sure your pitch deck, like model, investor FAQ, like they're all ready to go, or else we'll say like, you're gonna have to fundraise later. Some of them don't really participate as much because they already raised pre-program or earlier in program. So it is customizable based on where you are at in your journey.
So one thing that I'm curious how you recommend people deal with is mentor whiplash. So you're meeting a lot of mentors, and one might say one thing, and the next one right after that might say the exact opposite. So you get this kind of whiplash, like people saying experts, right? They're all like experienced professionals saying exact opposite things. Like how do you recommend founders, and founders who aren't going through Techstars are hearing that just generally, like what's your recommendation on how they navigate some of that?
Yeah, for sure. We have an engaging mentors presentation week 1, and everyone thinks it's fluff and like skips it. And then they realize how important it is after like weeks 2 and 3. I mean, this is going to be like life for your company. Everyone's going to tell you to do different things for your company. Like you should go fully B2C. You should go fully B2B. You should fully pivot. Why are you focusing on this market? Like at your heart, like you as a founder know the problem you're solving. Like this is the thing that I will not move from, and like these other areas I'm willing to budge. And just keep that in mind before you talk to all these mentors or like investors who will tell you different things. Also, I would say look at their LinkedIns and research them beforehand, because they're going to be super biased based on their backgrounds. Like if they had, like a consumer social startup they worked on that like really failed, they'll be like, why are you doing that? You should do a newsletter. Like that's going to be way better for increasing engagement. Like they're going to be biased based on their failures and things like that.
Now, how much are founders focusing on building their business versus balancing the fundraising process? Because leading up to demo day, it's a big point. It's a great opportunity for raising capital, but you have to build your business too. How do they go through that balance?
I mean, this is why being a founder is so hard. You have to do so much. This is, again, why we're kind of biased towards two co-founders, because fundraising is truly a full-time job, especially if you want it to happen quickly, aka less than 3 months. I would do it completely full-time as a CEO. Stop working on your business. Let your co-founder fully work on product sales so your business stays afloat and keeps growing. But, you should full-time do fundraising as a CEO. And make sure everything you have in place is ready before you start. It's really about creating calendar density, kind of generating FOMO with investors, telling them it's kind of getting a job. You're hey, I have this job offer, and people aren't going to be quick about the job offer until you have a bunch lined up. You can negotiate them against each other. Investings like that, but way worse and way more opaque, basically. Yeah, did I answer the question?
Yeah, I mean, I think it's a tough balance. In some ways, building your business can help you fundraise because you can make more traction and it'll help you fundraise. And so balancing that.
Yeah, the worst is when a single founder, CEO, and co-founder are both involved in fundraising, but they're kind of working part-time on the business. So then the business is slowing in growth and the fundraising is not going well. And then the investors are check in later, in a month or 2 months. And then they're check in a month or 2, and the business actually slowed in growth, actually hurts them. And there's just kind of this slippery spiraling down circle, actually. Yeah.
Got it. And then in terms of the program itself, you've seen a lot of programs go through. What do founders say, many months post-program was the most beneficial of that time in the program? What was the most helpful to them?
In terms of what came during program?
Yeah, what maybe for the resources or just even having the time to focus or
For sure. I would say realigning KPIs. A lot of people were focused on the wrong thing maybe, or didn't know what to focus less on and really double it down on. And they need a good third party to kind of talk them through it. The mentors, they were always complaining weeks 2 and 3, be I'm trying to build my business. Why do I have all these meetings weeks 2 and 3? But having those relationships early really unlock things later. You trying to get sales meetings on your customer meetings on your own could take months, while one mentor could unlock a bunch of high quality ones in a week for you, but they wouldn't notice that till later.
It's almost too much of a good thing. You take it for granted, but
they take it
afterwards. Trying to get people to meet with you is really tough.
Yeah, they never realize they do on their own later. Yeah, exactly. Same with Investor Week, I would say. There's someone I don't want to meet this person or whatever. I'm okay, well, I did a lot of work to get you these meetings. That's fine. You can do whatever you want. But then they realize creating a calendar density on their own is pretty difficult. So really taking advantage of a certain time you can fundraise. And also the business associates. Apparently I always undersell this every year. There was Christine, you didn't really talk about the business associates. I talked about this during the call, having this free help, but they're I don't think people realize how much it can accelerate your business to delegate a ton of stuff to these really smart associates that we guide on how to help you make your sales list and stuff when you're 2 co-founders on your own doing everything.
Yeah, real tough. All those resources are, I don't know, they're rare to come by, so it's super helpful. Now, the program itself leads up to a demo day. First of all, with the demo day, can you just walk us through what that experience is like? I know there's a lot of prep for it, a lot of practice to kind of do the demo, but tell us about that process. Yeah,
for sure. So I would say, again, for our program, Investor Week is really where the main fundraising happens, and we push for decision makers, partners or principals at least, to come to Investor Week. Demo day is kind of where we open up a bit more. Almost any investor can come in. We let you do mutual opt-in intros. You get around the same amount of intros with each, actually, I would say, when I actually calculate the numbers, but you get higher quality converting ones, I would say, from Investor Week. But demo day, there's always a crazy amount of attendance. There's always 2,000 plus RSVPs, 1,000 to 10, and you never know who's going to be in the crowd who's coming in. I'm always surprised by how some checks get written during demo days, which is why we still keep it. In terms of the prep, we're just making sure your pitch and deck are up to date. And like your pitch and deck are just like on lock. And I think that demo day pitch is really useful for like, I call it like the drunk at a party test. Like even if you're drunk at a party, you happen to meet someone important, you could like pitch your company so people will like find it super interesting, like, you know, like in less than a minute. And they're like intrigued to learn more, basically. And that's kind of like that muscle we're building in people, because if you're builders, you're probably not naturally good at pitching. Yeah.
Yeah, it was interesting. A couple months ago, I was doing pitch feedback right over here. And it was interesting, KJ was saying that they won't even if you're not up to a certain level on your pitch, they won't even let you do demo day.
Yes, because it's going to hurt you.
Yeah, it's not going to be prepared. So
yeah, first impressions matter.
Yeah, and I think for those of you who came to our Union Square Ventures talk, you heard Jared Heck, who's a former 2X founder, now VC, talk about storytelling. And that's what the pitch is all about. It's like telling a cohesive story. And is it a 3-minute pitch now, or is it?
3-minute pitch for demo day. And then we train them on like a shorter, I would say less than a minute pitch for investor week. Yeah. I mean, it's like, you're just so in the weeds. Like with your company, you're like the ultimate expert in what you're building. It's so easy to forget that like a lot of people don't know what you're talking about. You get too in the weeds. So you need to like figure out the spicy stuff they can get, just so that they're like, wow, I really want to learn more. I really want to like book that 30-minute meeting. Yeah. Yeah,
great. And then after the program's over, what happens to those companies? How do you all stay in touch or help those companies along as alums?
Oh yeah, we call it Techstars for life, because we really do support you after program. Like I'm helping companies raise their like seed, Series A and beyond, like helping them build investor pipelines using PitchBook and things like that, or like looking at their decks. We have unlimited office hours after that you can book. All the alumni, a lot of alumni, even especially our top alumni, even will come and give back during the program. Like they'll come talk to alumni fundraising panel and give like tips on fundraising. It's usually a little bit more real than the investor fundraising panel, I would say. And like, you know, they'll come back to be mentors. And you know, like I think you'll see like give first around this office, because that's like the biggest Techstars model that's kind of like drilled in. It's like give first, like don't care about what you're receiving in return. And that's really true. I would say like I will send forwardables to like Techstars alum that I haven't even worked with personally. And they're like willing to talk to one of my Techstars founders, because like it's just such a strong community.
Yeah, it's like those are, it's like summer camp. You remember if you went to summer camp growing up, you built a lot of deep relationships in a short amount of time because it was such an intense experience. So I remember from my days, you know, staying in touch with some of the founders. We just made an investment in a founder last week that was Sanjeev, who's a ClassPass co-founder. So it's like staying in touch and having relationships like decades later is super valuable. So yeah, I want to ask a couple more general questions, and then we're going to do questions for the audience in a little bit. So get your questions ready as we kind of wrap up the fireside chat portion. But there's a ton of accelerators out there, obviously. I mean, maybe 10, 15 years ago, there's only a few, Techstars being one of the kind of the first and more prominent ones. Yeah. When you recommend founders to evaluate accelerators, what are you recommending they look at, and how do they evaluate it?
Yeah, for sure. I would say it's kind of like diligencing any fund. You obviously want to diligence the fund or the accelerator from alum who've gone, but most importantly, make sure you're talking to someone who's like worked with that team that you're working with specifically in the fund, because your experiences can vary. So you want to talk to both like, you know, a founder that's done well, who's worked with that managing director, but also like maybe ones who haven't done as well. I mean, if you're at the offer stage, you can ask for referrals to past folks. Like we had some companies ask for that before accepting our offers. Yeah, I mean, you can read whatever you want online, but I always like look for people who've actually worked with investors to get real diligence. Yeah.
And when you see some of the accelerators out there, what are others, like, I don't want to call them warning signs, but signs that might not be the best, highest quality?
Usually if they don't want to share, like they only like have like one or two folks they'll have you talk to, instead of like being like, here's the list, just pick whoever you want. Or like, let's just find anyone who's most relevant to you that you can talk to, things like that.
Got it. Now, what type of founders should not do an accelerator, or founders or startups should not consider doing an accelerator?
Yeah,
you mentioned like very early stage. There's nothing to accelerate. But
yeah, if you're pre-product, I just think I just don't think it's quite worth the equity, because we can really help you with growth. Like we can't help you and we can help you iterate on the product and like sell, like talk to customers and kind of get to like product market fit that way as you learn. But if you have like nothing, no MVP, like we can help show to customers, like we're just like watching you build basically. So there's only so much we can do basically at that point. Yeah.
Got it. And last questions before we do audience questions. How would you differentiate Techstars as an accelerator or as a program compared to Y Combinator or other ERA and the other accelerators?
Yeah. I just really think the amount of personalization we do is like above and beyond. Like we have like 6 team members for 12 companies. It's like a really incredible ratio. I don't really know other accelerators that have it like that. So like, it's just like the mentor, I mean, it's kind of exhausting, but like the mentor recruitment, like the workshops, the investors, like it's just so personalized to 12 companies that we have each batch, which is why it's like so much work pre-program. We start like 3 months before program starts working on things. And like, I don't know anyone else who has business associates like us either. Like it literally gives you employees to like help you like get there as fast as you can, especially in like things you might be weaker at as a founder, like financial modeling, I would say. Yeah.
Okay, awesome. Let's open it up to questions. And I'm just going to repeat the question because we're recording it and we're mic'd up. Does anyone want to start with their first question right over here?
So you talked about startups that are pre-product, and accelerator might not be the right move for them. And also, founders who are part-time might not have the best luck or chance of getting into a accelerator. When should a founder or founding team consider making that switch from part-time to full-time, especially when they might not have enough funding to have a long stretch of building full-time without fundraising?
I'll just repeat the question. So the question was about when teams should make the leap from part-time to full-time. Obviously, there's financial constraints people have, and it's not an easy leap to make for everybody. What's your recommendation?
Yeah, I mean, that's why, financial constraints are something to consider. And that's why, I think that's so great. There's so many, equity-free early grant programs and, even programs like ours that, would enable founders to, actually quit and go full-time versus, because it's, if they had to pitch VCs and get fund money. In terms, we've taken founders where they're like, hey, if we get into Techstars, we'll go full-time. That's the way to balance the risk, because then, you have a guaranteed, amount of funding and support, so you can go full time during program. And in terms of taking a leave, that's really up to you, based on your own financial considerations, I would say. And I think usually people are like, okay, it's once I get to this amount of funding, or once I get to this amount of MRR, you kind of see the growth slope, and you're like, all right, this is relatively de-risked. Yeah.
Over there. Yeah.
Hello, my name is Britt. I'm the CEO of Up, and my question is, there's a plethora of founders building with AI. It's almost become a buzzword. So from an investor perspective, what are your green flags and red flags when you hear we're building with AI?
Now, what does AI stand for? I'm just kidding. So the question was, what are the green flags and red flags as people are talking about AI? Obviously, that's, at least we see when we do these events. I thought we counted it out once. It was 75 to 80% of people are doing an AI-related startups, or maybe they're just squeezing that word in for the buzz. But what are your red flags and green flags there?
Yeah, I would say it's more of a yellow flag if I see someone shove in the word AI, obviously in a business that doesn't need it that much. And there's still plenty of non-AI businesses that are totally worth investing in. That are doing really well. Don't pretend you're something you're not. But sometimes I'll be like, okay, maybe they're just really bad pitching, or they're scared. So I'll look deeper at what the business is. I would say more the bigger red flag is when you actually talk to the company and you dig into the tech layer a bit and you realize it's purely a ChatGPT wrapper. And then it's okay, cool. What's your defensibility going to be as you grow over time? Even if you get to market really fast and have a lot of traction, it's how is this going to last? And defend itself from competitors. That's what I look at more.
Yeah, I think my last 10 years been in the blockchain crypto space, so it was kind of like that for a while, where you just squeezed in blockchain or crypto and you got your fundraising. But the question I used to always ask is like, why does this have to be a token or a blockchain? Like, why can't you do this without? And it's often, that's my yellow flag, is like when they can't explain that and there isn't any meaningful kind of reason. But good question. Right here in the black.
Thank you for Q&A that you had. Is there a best time to do fundraising with the private equity shrinking and private capital coming in? What about the market trends? What are the best times to make that?
And the times as in time for your company, or time in general, like in the broader economic?
Relationship between your company, of course, but then market needs to play in favor.
Got it. So the question is there a best time to fundraise?
Are you saying raise from PE or just fundraise in general?
Fundraise
Okay.
Oh, specific to private equity. Okay.
This is a little bit out of my wheelhouse. I'm more used to companies that are like way bigger, that like might need to get kind of flipped a bit, that end up like raising from PE.
Maybe also from VCs, like maybe you can just add to that question is what the market hasn't been great in fundraising, and maybe some folks are working at their jobs right now trying to make progress and wondering like, hey, when do I go out there and pitch? If it's like not that great, is that a good time because there's not as many startups? Is it?
Yeah, I don't think it's great. This is a great answer, but I do feel like VCs are kind of biased from like really early stage companies, like pre-seed or earlier, that raised from PE. It's kind of like, why couldn't you raise from like angels or like micro funds? Like, is there something wrong with the business? Is it not venture scale? I feel like there's a bias there, unfortunately.
Yeah. What about generally the VC market as you've seen it? Maybe just like what is your opinion on like the state of venture funding? Are we bouncing back? Are we still in this kind of awkward period?
I think it's definitely bouncing back from like 2 years ago. Like I definitely see way more checks being written, and there's still companies that will raise seeds with like zero traction these days. It really depends on the market you're in. Like we had some companies that are like in the commerce space, and they're like $1 million ARR, and like they were just getting fewer VC meetings, I would say, just like less interest in that space, but they made up with it with like traction. While like other companies, like they had way less traction. They were getting like more meetings because they were working in like a hot market, like whatever like VCs consider hot at the time. And you were asking like when's the right time to fundraise? Was that the other question?
Considering the market situation, and rightly to us, is what you mentioned about what is the best time for a person who's working on their startup to say this is the best time I will be able to raise funds and I should do it, because right now, as I'm exploring, people are saying this is not the best time to wait and start.
Oh, is it because it's summer and like VCs are all in Europe on vacation or something?
No, the returns and IPOs are not happening, and that's why the returns are not coming. So the funds aren't getting the returns on their investments. So that's where.
I mean, I think the tough part is it's a matter of how much traction you have in your business, right? There's always going to be funding for companies that are making traction. So I think part of it might just be the mix of, if there's fewer investments happening, the ones that have the most progress are getting that funding.
Yeah, I mean, it's kind of like saying like when's the best time to look for a new job. It really depends on the person and the company. I mean, you can kind of tell based on like if you start getting like random associates who are outreaching you on LinkedIn or email, like asking to talk to you, like maybe like there's some kind of interest in your market. Also, sometimes that's their job, so I wouldn't always count that as real interest. But also, like if you see companies in a similar space being funded, then there might be some interest in that market. It's just really hard to like get the news early, I would say, unless you're in the know, because like a lot of like fundraising announcements like are way later to the public. Yeah.
Other questions?
Yeah, I have a question. What is the difference between JP Morgan program and the regular program for the New York City, and how it's like how you little bit they change the fees for the for the next acceleration programs, and what is the valuation after the program?
The valuation. Well, why don't we start with? I think we covered some of that.
What is piece, and what about the valuation after the program?
The valuation of, I think that might be on an individualized basis, but maybe starting with the first question.
It was like the $7 million, and what is the, it should be dramatically after the program?
Maybe we can talk the first part of the question about the differences between the program. I think we covered some of that in the beginning, but I don't know if there's
a difference between JP Morgan and a regular New York program. The main difference really on all the Techstars programs, I would say, is really talk to the team, who you're interviewing with is who you will be working with. So there's plenty of companies where you're super strong, and then we do a whiteboard session with them, 45 minutes. They see our coaching style, and maybe they don't like our coaching style, so we'll refer them to another Techstars program. So see if you like the team you're interviewing with. There's also different investment philosophies. You'll see different focuses on the different program pages based on what the team is interested in at the moment. I would also say, also with the partner programs, the partner will be a little bit involved, JP Morgan, the Start Banking team is a little bit more involved, helping our company succeed. But they're pretty light compared to other corporate partners, I would say. Yeah.
And I think the second part, maybe just a general question about trends and valuations.
If you start from 3.5, it's different for the seed investors and how it's dramatically,
Would you mind starting with 3.5?
Yeah, we just start from the specific evaluation before the program and how it should be after.
Okay, we've had companies raise at a higher valuation before a program. It really depends on your market and traction. Not to do a job analogy, but it's what kind of salary you should expect, and bonus. Yeah. We had a health company that just raised on a 10 mil, 3 on 10, but they're in a hot space. Another, it was hardware and it was pre-product. So they're also based in Israel. So they're raising a little bit lower. Yeah.
Got it. Okay. Any other questions right up front?
I'm working with this program at Pace University where we help students and faculty on pre-idea stage. So before they're going to apply for Techstars or other accelerators. And my question is, what are most common red flags that founders do in applications?
So the question is about red flags in their applications. Got it.
Sometimes I read something from past, I'm 2 times founder, and when I'm reading what I posted half a year ago or something like that, I see I did it wrong. So I'm sure that there are some common red flags that startups do mistakes in how they use wording in the problem, in the solution.
Yeah.
Can you mention just 1, 3 most common red flags?
Yeah, I think Christine mentioned the red flag of being too verbose, but anything else?
Too verbose because I don't want to miss the goal. I think, don't hide the gold. If you got, there's some companies, they're I have 500K ARR. It's nowhere in your deck, it's in the back. Show the important stuff up front, be succinct with your problem solution, be really clear. If it's a crowded market, show how you're differentiated from the competitors. If it's not a crowded market, show there's not many competitors, show how it's a big market usually. Otherwise, why are there not other players in the space is usually a question. Showing all the co-founders, things like that.
Awesome. All right, before we thank you, what is the best way for people to get in touch with you? Is it email?
My email is literally listed on the Luma page that you sign up on. So I'm taking applications right now. So it's a little funky. You have to apply on techstars.com, and then I can manually add you to our program. But also if you just have questions before applying, because I know that can take 20 to 30 minutes, just email me. And I always eventually reply to emails, even though it may be a little slow right now because I'm going through so many applications right now. Yeah.
And the applications, what's the status of the application? I know, did the deadline
pass? Deadline passed. So everyone will be notified they're moving on to the next round by, I think, next week, actually. And then so everyone knows they got an interview. And then, we'll probably select offers like late July,
Got
I would
it.
say. Yeah.
But if you are interested, I mean, you're recruiting all the time for the next program and the next program. So
Yeah, because we do give like rolling offers. Like we'll give out earlier offers and later offers. Yeah.
got it.
Mhm.
Okay. Awesome. Well, thanks so much for speaking with us.
Thanks for having me. Yeah.